Hello, how are you doing, friends? I'm your stock analyst, CT, driven by a deep passion for the stock market. I'm here to share data driven insights and how you make smarter, more confident investment decisions.
Let's start by reviewing last week's stock analysis. Stingray Group. How did it perform and what can we learn from it? Let's break it down. Last week, CT covered Stingray Group Inc. RAY.A on the Toronto Exchange. What? And last week, what a roller coaster it was. The market took a sharp dive as Trump shook things up, threatening Canada and Mexico with a massive 25% tariff hike. In response, the Canadian government scrambled to plan retaliatory actions against the Trump administration. The tension was palpable from the get-go on the day one of the trading. Stingray tumbled 4.1%. Then came Trudeau's last-minute update. He had a good call with Trump, and the tariff hike was put on hold for a month. But by the time the news broke, it was already 5:36 p.m. Too little, too late for the markets to breathe a sign of relief. Luckily, the stock made a strong comeback on Tuesday, bouncing back on the positive news and closing at around 8.3. After the market closed, the company released its earnings report, which turned out to be a pleasant surprise for investors. By Wednesday, the market reacted with enthusiasm, pushing Stingray stock up by 7%. However, after the initial excitement, things settled down and the stock remained relatively quiet for the rest of the week. Stingray Group has a strong Q2 2025. Revenues jumping 13% to 93.6 million, thanks to booming fast FAST channel sales and more digital signage in stores. Profit was up too, and with adjusted EBITDA rising 15% to 33 million, and net income hitting 16 million. Plus, they bought back 333,000 shares worth 2.5 million, showing confidence in their growth. However, Stingray is a cyclical stock highly sensitive to market conditions, making it crucial to stay informed and keep updated with current events and navigate its movements efficiently. Next week, several major Canadian companies are scheduled to release their earnings reports. The big name, on Tuesday, Spotify will announce its earnings before the market opens. Following that, Wednesday, both Cenovus Energy and Barrick Gold are set to report their earnings. Then Thursday, Thales and GoEasy will release their financial results. On Friday, Enbridge, Air Canada are scheduled to announce their earnings, with Air Canada's report expected before the market opens. Which of these stocks are you watching? Do you expect any surprises? Or are you staying on the sidelines? Let me know what stocks interest you the most. Looking at the news, Trump's energy policies has a major impact on the market. He's all in on oil and gas, ramping up drilling, slashing and environmental regulations, and opening new lands for fossil fuels exploration and all under the banners of American energy dominance. Meanwhile, he's been openly skeptical of renewables, cutting funding and permits for clean energy projects. while taking jabs at wind and solar power. But here's the twist. Despite his push for fossil fuels, renewable energy is still growing, fueled by market demand and technological innovation. Speaking of energy, I have come across a fascinating stock that's been a key player for nearly 50 years in the oil and gas services industry. With energy demand constantly evolving, this company has managed to stay ahead of the curve, adapting and innovating through decades of market shift. Since energy remains essential, let's dive into what makes this company stand out. Introducing Computer Modeling Group, CMG, a leader in the reservoir simulation technology. Before we dive into CMG, let's talk about the oil and gas industry. The traditional oil and gas industry is a massive interconnected system that powers the world, dividing into three key sectors: upstream, midstream, and downstream. It all begins with the upstream sector, which focuses on exploration and production. This involves identifying oil and gas reserves, drilling wells, and extracting raw resources from beneath the Earth's surface. Once the crude oil and natural gas are produced, they move into the midstream sector, which handles transportation, storage, and distribution. Pipelines, tankers, and storage facilities play a crucial role in moving these raw materials to refineries and market efficiently. Finally, the downstream sector takes over, focusing on refining crude oil into usable products like gasoline, diesels, and petrochemicals, and marketing them into consumers through gas station and other distribution channels. Together, these three segments form the backbones of the oil and gas industry, ensuring a steady supply of energy to power economies worldwide. Computer Modeling Group operates in the upstream oil and gas sector, specializing in reservoir simulation technology. Their software solution help energy companies automate oil recovery, enhance production efficiency, and model complex extraction processes. CMG provides consulting services for conventional and unconventional oil recovery, carbon capture, geothermal energy, and hydrogen storage, supporting the industry's energy transition. Additionally, they offer storage monitoring solution, ensuring safe and efficient underground resource management. Okay, let's break down CNG's revenue growth. Looking at the chart on the left, from 2019 to 2023, CMG's annual revenue remained fairly stable, hovering in the 70 to 80 million range. But 2024 brought a major breakthrough thanks to the strategic acquisition of Blueware, a software and services company specializing in cloud-based deep learning for subsurface decision making into seismic interpretation. This supercharged growth led to 106 revenue increase in the US and 45% leading to a jump in South America and 47 boost in the Eastern Hemisphere, largely driven by CMG's expanding consulting services business. Now, Looking at the tree map on the right, summarizing from CMG latest quarterly report, we can see how revenue is now distributed globally. The Eastern Hemisphere leads to 37% of the total revenue, with 34% coming from software licenses. South America contributes 11%, with 9% from software licensing, while the US and Canada make up 30% and 19% respectively, with a balanced mix of software license and professional services. This strategic expansion isn't just about revenue, it's all about global reach. By broadening its footprint across key markets, CMG had positioned itself for long-term growth and industry leadership. Looking at the profitability ratio chart on the left, we can see that margins has been trending downward since July 2023. Though there was a slight uptick recently on the right, we can see a somewhat disappointing return on the asset, raising question about CMG's operational efficiencies and whether its earnings are keeping pace with its expansion. This brings up to key concern. Is CMG operating at peak efficiency? If not, how far is that? Is earnings growth and profitability aligned with its rapid expansion? It's also important to consider the broader struggle in the energy sector. Volatile commodity prices, geopolitical uncertainties, and shifting industry dynamic have created challenges for a company across the board. As CMG scales up, balancing growth with profitability will be crucial for long-term success. As the world grapples with rising energy demand and the push for sustainability, CMG stands at the front, leveraging AI-driven simulation technologies to optimize reservoir performance. With the expansion of software licensing and a growing demand for consulting services, the company is well positioned to capitalize on the industry's digital transformation. However, challenges remain. The oil and gas sector is highly cyclical, with tariffs, geopolitical risks, and market volatility creating uncertainty. Additionally, CMG stock is trading at a high PE ratio, raising valuation concerns compared to its peers. The key question: can CMG sustain its momentum while navigating industry risks and justifying its valuation? The answer lies in its ability to adapt, innovate, and balancing growth with profitability. After factoring in key considerations, CT ran a multi-stage discounted cash flow model to assess CMG's valuation under different scenarios. Optimistic case, $9.35 per share. Risk adjusted case, 56 per share. Pessimistically speaking, 5.96. Even in the most optimistic scenario, the variation falls below the current trending price, leading me to take a bearish stance on the stock. However, despite short-term concern, I remain eager to see how CMG navigates industry challenges and executes its long-term growth strategy. The road ahead may be uncertain, but innovation and adaptability could be key to unlocking future value. From a technical standpoint, CMG has been trading in 10 to 11 range over the past week, with a potential support level at around 9.5. A break below 9.5 could signal a lower low formation, reinforcing the current lower highs trend. Meanwhile, trading volume has picked up recently, likely anticipation of the upcoming earning report, which could be a catalyst for increased volatility. However, the stock remains below its 200 moving average, which is 11.74, indicating a weaker long-term trend. Is it a deep buying opportunity or a sign of further downside? What's your take?
Wishing you a great trading week ahead. Let me know your thoughts in the comments. Bullish or bearish? Don't forget to like, subscribe, and stay tuned for more market insights. See you in the next one. Bye.